Welcome to S&P's European loan market video overview, detailing leveraged finance trends and activity during May and early June 2010. I'm Suchit Gupta, a member of S&P's Leveraged Commentary and Data Team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe, before winding up with themes to watch for in the months ahead. Before we start, please know that you can follow LCD on Twitter, Facebook, and can join the more than 3,600 contacts in LCD's Leveraged Loan Group on LinkedIn. The links to follow LCD are in the info section on your YouTube channel. As always, before getting down to business, some fine print. This disclaimer, courtesy parent company Standard & Poor's and McGraw-Hill, covers all the bases. Please read it at your leisure. The loan market finally succumbed to the fallout from the European sovereign risk concerns in May. Loan returns fell to negative 1.55%, the second month this year where loans had negative returns. However, it's been an unbelievable trajectory for loans, with the LE up 50.3% between January 2009 and May 2010. The immediate fallout from the sovereign crisis was its impact on the high-yield and IPO markets. Both high-yield and equity issues got pulled as the VIX volatility index moved beyond 26. This drop in capital markets activity has slowed the amount of cash coming into loan accounts that had to be put to work. Even though there was a strong risk aversion in the capital markets, loans softened a bit in the secondary, but avoided a mass sell-off as trading was extremely light. Improving fundamentals were seen in the default rates, both on the principal amount and an issuer count, as they eased again in April. As for new deal flow, loans outpaced high-yield issuance. There were 8 new loan deals that launched in May versus 4 high-yield that priced during the month. Getting back to the secondary loan market, this chart details the average price of LCD's European Flow Name Composite, a measure of the 18 largest, most liquid loans consisting of 10 issuers since 2002. The secondary softened a little in May as a slop from the PIIGS spread through the financial markets. Focusing on the last month, the loan flow names initially fell almost 3 points with very light trading. The biggest difference between May 2010 and September 2008 is the absence of leverage. There aren't as many 8 to 9 times total return swaps programs or warehouse lines for 12 times leveraged CLOs, so there isn't any forced selling. The only selling is opportunistic, where managers feel certain names have met their return expectations, plus trading desks shrinking their trading books. Another indicator of the softening of the secondary loan market and increasing risk aversion is the widening of the average bid-ask spread. At the end of May, that average had widened out to 143.75 bips, nearly 40 bips wider than the start of the month, and the highest level since the end of December 2009. Looking ahead, players still expect secondary markets to be soft, with little volume trading on the back of the sovereign crisis, coupled with the lack of clarity on regulatory affairs. This chart details the monthly return of S&P's European Leveraged Loan Index, the LE, a broad measure of European loan market returns that LCD calculates. The main point here, the European loan market posted a loss of 1.55% for the 4 weeks ending May 29, 2010, driven entirely by the loss in market value. By comparison, total return was positive 1.78 at the end of April 2010. This brings the year-to-date return to 4.63% versus a negative return of 13.52% for the same time period last year. Now from the secondary, we turn to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. European leveraged loan issuance overtook high-yield issuance in May for the first time this year. 8 loans were launched totaling 5.1 billion, 3 billion of which is for Heidelberg Cement's latest refinancing. Excluding Heidelberg, volume stands at 2.1 billion, which is in line with historical average for new issue volume. Just 4 high-yield issues priced in May, totaling 735 million. Default rates continue their southwards migration. The rate by principal amount decreased to 7.42 at the end of April from 7.83 at the end of March, while the default rate by issuer count decreased from 10.83 at the end of March to 10% at the end of April. In summary, The fallout from the PIIGS is not over as yet. This, coupled with regulatory uncertainty on both sides of the Atlantic, will have a knock-on effect on high-yield issues as well as IPOs, severely limiting repayments. This decline in repayments could result in new issue deals being flexed up on a yield basis, or banks just not syndicating and holding it back on their portfolio books, something European banks are very adept at. The forward calendar of true new issue loan volume remains less visible. Though there are more deals that are being closed on a multi-arranger club basis, it's still uncertain whether these deals will be syndicated. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including U.S. market loan wrap-ups from March, April, and May. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.